So you've started investing. You're putting away 1,000, maybe a couple thousand a month, and you're hoping to turn that into a few million one day. But what if a few million in the future only buys you what a few 100,000 buys you today? In this video, you're going to learn just how much inflation can take away from your investing returns, but also what you can do about it to protect against these losses. So stick around to the end to find out how this week on Investing Easy. Why does inflation matter? It comes down to purchasing power. Let's say you have $100 today, which means you have the purchasing power of $100. But $100 a few decades from now may only have the purchasing power that $20 or $30 buys you today. That may sound depressing, but it's not as sad as me finding out on a Monday morning that I've run out of coffee. The thing is, your investing returns may be moving in the right direction. But inflation is also moving, eating into those nominal returns. So unless you have some powerful voodoo spells, it's going to leave you with a lot less real returns. If your returns are much greater than inflation, then you won't really notice much difference. But if your returns are modest and inflation is high, it leaves you with very little real returns left over. That's the returns that matter. Let's take a look at an example to see what this looks like. Let's say across all your investments, your weighted average returns are expected to be 6% per year. Remember, those are nominal returns. With inflation at 2%, you can expect 4% real returns compounding over time to build wealth. But if inflation rises to 4%, it cuts deep and leaves you with just 2% real returns to compound over time and build that nest egg. With a fixed budget every month, you'd need to be drawing down much more of your investment principal rather than living off the returns that your investments generate every year, and so your wealth can drop dramatically. To put this all in context, we need the power tool to simulate an example. Let's say you're 30 years old and want to stop working by 60. You've got $100,000 today and managed to save $2,000 a month to build that nest egg. When you're no longer working, you plan to withdraw $5,000 a month until age 80. The power tool shows us that with 2% inflation over the time that you're invested, you are well in the clear. You have strong odds of weathering the market ups and downs to preserve that nest egg until at least 80 years old. You're getting an expected value of somewhere between 1 and 4 million, depending on stock market performance, even with a conservative investing risk tolerance. In other words, less stocks and more bonds. But what if inflation is higher? At 3%, this changes things. You no longer have a clear chance of maintaining those savings to 80 years old. Your odds are now equally as likely that you will run out of money than not. It's almost like a coin toss, 50-50. And at 4% inflation, your chances of preserving your nest egg fall off a cliff. In fact, you would most likely run out of money by age 70 to 75 and be in debt by over 4 million at age 80 if you didn't adjust your spending habits. But what if you bump up your investing risk tolerance, think more stocks and less bonds, in order to try to get more long-term average returns? That way, after inflation, you're left with more real returns. If you took a bit more aggressive approach to risk with more asset allocation towards stocks, it gives you more upside potential in the best case scenario, but not a huge improvement in the most likely outcomes that you can expect. So it's not exactly a game changer, but it does help out somewhat. If this is surprising to you, leave a comment. I'd love to hear what you think. The truth is that inflation can dominate the financial outcomes and probabilities that you can expect as an investor. This makes it very important to understand when making your financial plan. The million-dollar question is how much the stock market will return over the decades that you're invested and how much inflation will be over the same time. We can't time travel into the future to find out, but we can look backward to understand how the markets have performed in the past. Over the past 100 years, the stock market has returned around 10% nominal returns, with 3% inflation leaving investors with 7% real returns. But the past is not always an indicator of the future. Most forward-looking economic outlooks from some of the world's largest asset managers are estimating long-term nominal returns of around 7% for equities with 3% inflation. In other words, 4% real returns. So this means we could have less long-term real returns in the future compared to in the past, potentially bad news as investors. But this makes it doubly important to focus on the fundamentals, the things you can control in order to set yourself up for financial success. So what can you do about it? Well, you could just ask the internet, but ChatGPT got me nowhere, so I'm going to save you time with 4 key takeaways. First, pay attention to fees, which, like inflation, can take a huge cut from your long-term returns. If you invest in exchange-traded funds or mutual funds, especially actively managed funds, you could be getting fleeced with high expenses. So do a bit of research to find something called the total expense ratio, or TER. The lower, the better. Next, consider stocks over bonds to give you higher long-term returns. Now, as we saw in the simulation, it's not exactly a game changer, but it does help somewhat. It does also mean, though, that you can expect more year-to-year volatility, so you want to consider that when deciding on your investing risk tolerance. Then go global. Diversify your portfolio with international exposure to smooth out the inflation volatility in individual economies. Finally, make your cash work for you. Don't have it sitting around being lazy. If you have an emergency fund, move it into a liquid, easily accessible savings account where you get a higher rate of return but can still access the money quickly if needed. And if you're saving for a big purchase like a wedding or a holiday, if you know when you'll be spending this money, put it in a term deposit that matures before you need that cash to get even higher returns than in a savings account. So what have we learned here? We now know that inflation can take a huge chunk out of your long-term investing returns, but you can take sensible steps to do something about it to an extent. The rest is kind of out of our control, so don't get too frazzled by inflation. It's really just one of many risk factors that we must consider and manage as part of our investing strategy. Hey, that's investing, baby. If you'd like to see a real example of someone's investing plan impacted massively by inflation, then check out this video. And if you still have questions, then please reach out. Feel free to ask away and I'll do my best to answer. Leave a comment with your opinion on inflation risk. I'd love to know what you think. You can find all the power tools and resources on the website. There's a link in the description below. And don't forget to like and subscribe. It helps out the channel so I can keep helping you make investing easy. We'll see you next time.